market structure is one of the most important aspects of trading. It is perhaps the most important aspect of trading, because a good understanding of market structure is something that is going to elevate your trading. And when I say it's going to elevate your trading, I mean what I say. Now, a lot of traders, I think they find it very difficult to map structure. Others find it very difficult to even identify whether the market is in an uptrend or the market is in a downtrend, or whether the market is ranging. A lot of traders find it very difficult because a lot have not learned how to understand and also how to identify market structure. So in this lesson, I'm going to show you how you can go about identifying your market structure and how you can use that knowledge, okay, to increase your levels of accuracy in the market. So now let us just begin. So before we get into the actual charts, where we begin to look at the market structure on the charts, I want us first of all to look at the theory aspect of the market structure. So now, what is the market structure? Market structure is the backbone and the foundation of the market. It is the backbone and the foundation of the market. Now, we need to understand that the market, okay, any market, whether it is forex, it is stocks, it is metals, or you are dealing with commodities, or you're dealing with cryptocurrency, has a structure. And the structure of the market is made up of only two moves. All right. So the market is made up of only two moves. And if I tell you to say the market is made up of two moves, you'll be thinking, okay, what are those moves? So the market is made up of an impulsive move, okay, impulsive move, and also it is made up of a retracement. Now, these are the two types of moves that the market is made up of. Okay, so we can say retracement move. All right, so it is made up of an impulsive move and a retracement move. That is what makes the market structure. So an example of the market structure, I'm going to give an example of an uptrend. We are going to create a market that will be pushing to the upside. Now, we need to understand that the market does not move in a straight line. Okay, why? Because the market has to breathe in and also has to breathe out. It has to breathe in and also has to breathe out. So it cannot just move in a straight line. So that zigzag movement of the market is what we call market structure. So there are 2 or 3 conditions in which the market exists. Okay, what are these 3 conditions? Number 1, we have what we call an uptrend market. An uptrend market is a market that is made up of higher highs and higher lows. So what we're going to have right here, we're going to have a low, and then we're going to have a low, then the market is going to produce for us a high right here, and then from the high, once we have a high, the next thing that we're going to see the market do is it's going to produce a higher low. Now, for an uptrend market, if the market is pushing to the upside, it has to be creating highs that are higher than the previous highs and lows that are also higher than the previous lows. All right, so this is what makes up what? A market structure. So we have a low, a high, a higher low, a higher high, a higher low, and a higher high. It is an uptrend market structure. It is an uptrend market structure. So we know and understand that if we are looking for buying opportunities, remember I said the market is made up of 2 moves. All right. The first move is called an impulsive move. What is an impulsive move? An impulsive move is the longest move in the market. All right. It is the one that leads to the creation of either a new high if the market is in an uptrend, or a new low if the market is in a downtrend. So this is called impulsive move. All right. So impulsive move is going to lead to a creation of a new high. All right. And then the market is also made up of a retracement. A retracement can be called many names. All right, it can be called many names. It is called an impulsive move, okay, which pushes to the up or which creates a new high or a new low. All right, and then we have a retracement. A retracement is the one that goes to establish or to retest a previous high or a previous low. All right, so if the market is in an uptrend, an impulsive move will be creating new highs. All right, it will be breaking highs in order to create a new high, and a retracement will be retesting previous lows. All right, in order to create a what? A higher low. Okay, so what we have is an impulsive move, a retracement, impulsive move, a retracement, impulsive move, a retracement. So based on this repetitive movement of the market or behavior, we are able to predict the next move of the market. You'll be able to predict the next move of the market. Let's say if what I have is, I can see I had a low, a high, a higher low, a higher high, higher low, higher high. Based on this, if the market begins to pull back, all right, I'll know where the market is going to move to the next time. So once the market gets here, I just have to look for clues that this pullback, or rather retracement, has come to an end, so that I can get into the market and take the next impulsive move to the upside. This is how we look at the market. So whenever the market is in an uptrend, all right, we have to wait for a pullback to come to an end. Now, another term for a retracement is called a pullback. All right, so another term for a retracement is called a pullback. So you can also call this one to be a pullback. And then another term for an impulsive move is also called expansion. All right, so I want you not to be confused when I begin to use these terms interchangeably, where you hear me use the word pullback or you hear me use the word expansion. They're just one and the same, and they're just describing one and the same thing. So when I talk about an expansion, I'm talking about an impulsive move. When I talk about a pullback, I'm talking about a retracement. I believe you understand what I am talking about. So there is a general rule whenever you want to take the market, to trade the market. Now, if you want to trade the market, one of the things that you shouldn't do as a trader is to buy when the market is already high, more especially if the market has just broken above the previous high, if the market is in an uptrend, or the market has just broken below the previous low when the market is in a downtrend. Okay, so you have to avoid doing that. Now, let's get back. Let's just do a recap of what we have just looked at. So we have looked at two moves that makes up a market structure, and we said the market structure is made up of two moves. Number one, it's going to be an impulsive move. Then number two is going to be a retracement. And we said that the market structure exists in three different conditions. And we said it exists in an uptrend, and I've just been explaining what an uptrend market looks like. I said an uptrend market is a market that is made up of the series of highs and lows. Highs and lows, highs and lows, meaning that what we're going to have is we're going to have a low, a high, a higher low, higher high, higher low, higher high, higher low, and higher high. For the market to remain in an uptrend, it has to keep on creating higher highs and higher lows. In other words, it should keep on respecting the lows and breaking the highs. And then I also said that an impulsive move, or rather expansion, is the move that goes to create a new high if the market is in an uptrend. So we are going to be seeing new high. All right, then I said a retracement or a pullback is the move that goes to retest the previous low, all right, in order to create a higher low. All right, so this is what we have in an uptrend market. Now let us also look at another condition by which, or in which, the market exists, or in which the market structure exists, and this condition is called a downtrend. All right, a downtrend. Now remember, like I said, the market structure is made up of two moves only. So whether it is an uptrend or it is a downtrend, the moves are just the same. So let us look at the downtrend. So now what we're going to have in a downtrend is the market that is dominated by what? Sellers. So if the market is dominated by sellers, what I expect to see is the market that will be pushing to the downside. So as the market will be pushing to the downside, what are we going to have? We're going to have the market that will be creating we have a high right here, not a low, but a high that now leads to the creation of a what? Of a low. So we have a high that leads to the creation of a low down here. So this is a low. Then from the low, the market pulls back. Remember, we only have two moves, a pullback and an expansion. All right. So this is going to go and create a lower high. Then from a lower high, we are going to have a lower low. Now, a downtrend is a kind of a market that will be breaking the lows and respecting the highs. In an uptrend, we are breaking the highs and respecting the lows. But in a downtrend, we are breaking the lows and we are respecting the highs. So what does that mean to us? It means if you are interested in looking for a selling opportunity, you are only allowed to sell in a downtrend. All right. You are only allowed to sell in a downtrend. Why? Because in selling with a downtrend, you are selling with the overall direction of the market. You are selling with the momentum of the market. So being on the right side of the market is more important as a trader. This is why it is very important for you as a trader to be patient and to be disciplined. It's not every move of the market that you are going to be taking. You have to wait. You have to be disciplined. You have to be patient for the right move to come to you. The market has always been moving since the time they were, invented, okay, up to now. So there is nothing that you're going to miss from the market. The only thing that you need is patience. Okay, so let's say in a downtrend, what am I looking for in a downtrend? The first thing that I need to know is I need to understand where is the market going to, where is the market coming from. All right, so if I see that the market is coming from this high, then it has created this low, then we are in a pullback to go and create a lower high. I will wait for signals right here. It could be candlestick patterns, it could be a chart patterns, it could be a W, an M, a head and shoulder, whatsoever pattern that I can get. All right, so once I get that pattern around here, then I'll get into a trade. All right. And where am I going to target? I'm going to target this previous low because I know that the market is going to take that low out. So once I have an established trend, all right, then I'm able to, at least with certainty, predict where the market is going to next. And this is very important. Okay. So in a downtrend, you don't buy the market, because there are other buyers that just don't want to be patient to wait for the market to give them the right direction. So they want to get here. They want to buy here. All right. Others will be wanting to sell here because why? They have been seeing how the market has been pushing in this move. All right. So now they think, okay, the market is going to move without me. So they want to start selling here. That is a wrong way of trying to sell the market. You'd rather wait for market to pull back or to retrace to go and create that lower high. All right. And after the market creates that lower high, then from here, you look for your confirmation entries. Then you start selling the market. Why? Because there is a rule in the market. And this rule, I'll write it down for you here. All right. So the rule for trading, okay, is, okay, so say buy low and sell high. This is a very important rule. You have to buy low, sell high, meaning that you have to wait for the market to become overbought, if I can use that term. You have to wait for the market to become overbought. So once the market becomes overbought, then you can jump into the market and begin to sell from right there. Of course, it has to come after a confirmation. All right. Same here. You don't sell here, or rather try to buy here. Quite all right, you can buy. But if you bought here, you'll be buying against the trend of the market. The trend is a downtrend. You can see we are not breaking these highs. We are respecting the highs, and these lows have been broken. So again, you don't know how deep the pullback is going to be. All right. It can be a deeper pullback. It can be a shallow pullback. No one knows. All right. But what we know is that we wait for the market to do what? To give us those signals that now the market will start selling, so that we can jump into the market and then we take advantage of this. Why? Because impulsive moves are going to be very big with huge candles. Retracements or pullbacks are going to be very compressive. Okay, so it's better you wait for the right strike or the right opportunity in order for you to strike. And that's it. Now let us get to the last part of the conditions in which the market structure exists. Okay, so what are these conditions? Now we are going to look at the ranging market. The ranging market is also one of those markets that have many traders like to trade, but I don't really trade it. I don't really like it so much. I'd rather trade with a trend, because the trend is your friend. So it's better you trade the market with the trend. So let's say we were in an uptrend. The market was creating higher highs and higher lows. Then the market gets to a certain level. Then it stalls at that level. Then it begins to create what we call, creating a form of resistance. Okay, so this, okay, is an example of a ranging market. So we are somewhere here where the market stalls and it begins to, move in a range kind of a situation. Now, at this time, once the market gets here, the market is in an indecisive phase. All right, we can see that market is coming from the downside going to the upside. So we can say that the trend that the market was in was an uptrend. Now, after the market reaches a certain level, it begins to consolidate. It is also known as a consolidation or ranging market. Now, that consolidation to us is very important. It's an accumulation, meaning that orders are being accumulated and the market makers have not yet decided where they want to take the market to. So the market makers can either break to the upside or they can reverse the market and take it to the downside. But there are other traders who would want to do what? To buy here, sell there, buy here, sell there, buy here, and of course sell there. All right, of course, based on maybe first touch, second touch, then they would want to buy on the third touch. Okay, which is quite okay. But for me, I would rather stay away from this kind of an arrangement because the market can just be coming for the liquidity down here. All right, and the market can also be going for the liquidity up there. So I'd rather stay away from that market and just wait for the right moment where the trend resumes. All right, so this is what we call a ranging market or a consolidation market. And in most cases, that market is not creating any new highs and lows, but rather it is just creating equal highs and equal lows. Now, quickly, let's just do a recap of what we have learned. So we've learned that the market structure is the most important aspect of trading, and a good understanding of your market structure is going to increase your win rate, if I may add, because it's a foundation of the market. Then we also said that the market structure, any market structure of any market, okay, whether you're trading forex, you're trading stocks, you're trading whatever type of a market that you may be comfortable with, is going to be made up of two moves only: an impulsive move and a retracement. And an impulsive move is also known as an expansion, and a retracement is also known as a pullback. Then we also said that there are three conditions in which the market exists. We have an uptrend market, which is made up of a higher high and higher lows, where the expansion will be breaking highs and the retracement will be respecting the previous lows. All right, and we also say there's a downtrend where the market is made up of lower lows and lower highs, where the expansion will be breaking the lows and the retracement will be respecting the highs. And also we said that there is